Welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
Welcome to another episode of the Defenders of Business Value podcast. I'm your host, Ed Mysogland. This episode, there's probably nothing more important in deals than accounting and the integrity of the financial statements. And as I've said on the podcast many times, valuation, it's earnings, it's growth, it's risk. Those three things drive value, and you have to have good earnings. And confused buyers don't buy. And so today, I've got Matt Remuzzi from CapForge on the podcast, and he has, CapForge is out of California. They are an accounting firm, and they do tax prep, payroll, coaching, and advisory services. And the thing that I really like about Matt is that he was a deal guy before all of this. So he understands the ins and outs and what's going to be required of his business owner clients. And that's why I invited him to the show. That, he's gone down this path a number of times, not only as a deal guy, but also now as someone serving in the accounting profession. So I am 100% certain that you're going to get a lot out of this episode. So enjoy my conversation with Matt Remuzzi from CapForge. Well, Matt, welcome to the show.
Thanks for having me. I'm happy to be here.
Well, I'm glad you are here. And as we're recording this in mid-November, one of the things that I keep on thinking about is those business owners that are going to begin talking to their accountants about perhaps selling. So one of the things I wanted to at least start off with is to talk a little bit more about your practice and how you're serving the small business community, because I do, and that's the point of this show. I mean, we're serving the underserved, giving them some information that they probably, have never or haven't heard enough, over the course of their time in business. So can you talk a little bit about CapForge and what you guys are doing?
Sure. So we are focused on small businesses. We do bookkeeping and tax. Bookkeeping is sort of where we started. That's our bread and butter. We've added tax over the years. And another area that we've added is really helping our clients think about selling and get through the process of selling. My background before I got into this was I was actually working as a business broker. Oh. And what would happen was, right, the first step in somebody says, hey, I'm thinking about selling my business or I'm interested. Say, great, let's figure out what the business is worth. Let's do that by taking a look at the financials. And then they go, oh yeah, the books. Yeah, they're 6 months behind, or, my Aunt Susie does them, and she's not really a bookkeeper, but she needs something to do. So we let her mess around in QuickBooks, or, there's a million different stories, but they all added up to the numbers were not necessarily current, not necessarily done correctly, and certainly not optimized for selling the business. So that was sort of how we got involved in, aside from doing the bookkeeping and tax, we work with a lot of our clients and a lot of business brokers who are working with their clients, getting ready to sell. And obviously that's why, you and I are chatting about this, because that's a big part of what our practice involves, is helping small business owners take their books from okay, or maybe not okay, or not, not even in existence, and getting them to the point where they can use them to get, a premium valuation and really have a painless sale process where there's not a million questions coming up in due diligence about, hey, what is this and what happened here and what's going on? So quick answer to your question is we're an accounting firm, bookkeeping and tax, but we have this side hustle, if you will, in working with business owners who are thinking about selling.
Well, and that's, why don't we start there? So you refer to optimizing for sale. What does that mean to a business owner?
Well, there's two parts to it. The part one is just having clean, accurate books, which sounds like, isn't that what everybody should be doing? Isn't that a pretty low bar? But it
You'd think.
often, it isn't. A lot of business owners, books are what I just have to do before I give everything to my tax guy, right? Or maybe my tax guy puts everything
Right.
together. I just give him a bunch of bank statements. But if you think about it from a buyer's standpoint, right, they want to understand and have confidence in what am I really getting with this? How much money is
Yeah.
really coming in? What are the expenses? How much is the owner getting to keep? And that oftentimes isn't the number on the tax return, right? When you think about
Right.
doing your taxes, you want to show as little profit as you can or even a loss, right? Because that means you pay less in taxes. But on the flip side, you want to sell it. Now, ideally, you want to show as much profit as possible because that's going to directly drive what this business is going to be able to sell for. So step one is just having accurate, complete books. That's
Yeah.
the baseline. But from there, then optimizing it to us means going through and pulling out all the personal stuff, right? We don't want to take it off the books, but we want to separate it out because that shouldn't really count against the value of the business. One-time events, things that may have come up. Let's say somebody sued you and you had a $25,000 legal bill defending yourself. The new owner isn't going to have to pay 25 grand in legal fees. So even though that was a real expense that the business paid, let's move it down into the section of other expenses that won't, again, count against how the business actually did. It's not part of your normal operations, not part of your normal expenses. So our goal is to go through with the owner and really pull the business apart so that we can document clearly and transparently for any buyer that's interested or the bank that's going to potentially provide financing for this acquisition deal, exactly how much business the business is doing, separate from all that one-off stuff, the tax write-offs, the one-time events that sort of pollute the activity, but aren't really what a new buyer is going to inherit and what doesn't really impact how the business itself operates.
Well, one of the and it's just happened in the last, I don't know, a year, maybe 18 months. We're starting to see sellers preempt the quality of earnings reports that the buyers typically do. And some of these sellers, how, I guess from a, I don't know if you do any Q of E work, but
yeah,
the question is, how do you, I think it's a great idea. To me, I think you substantially changed the negotiating leverage with the buyer. If you hand them whether it's a limited Q of E or whatever, something that says, you know what, you can rely on this. We'll rep and warranty these numbers, more so than just kind of take it at face value. So I guess my question is, give me the wraparound service. How does that work when someone says, I'm going to put the business on the market. I need your help. Tell me what Q of E means to you and how that relates to the buyer.
Yeah, and you're right. And we've been getting more and more requests from some of the brokers we work with. Hey, I've got this business. They have 5 million in revenue, $1.5 million in EBITDA. Before we go to market, can you just look everything over, review, pretend you're the due diligence team, which we do plenty of that as well. What would you find? What would you have questions on? What do we need to back up and make sure that we have good answers for, or just clean it up to preempt even there being a question? So that's exactly what we do. We essentially put on our due diligence hats as if we were working on the buyer's team. And we go through the whole thing from top to bottom and say, can you explain this? This doesn't make sense. Why is this here? What was this transaction? What happened? And anything that can be moved or cleaned up or recast in a way that's going to either prevent the question altogether or at least give us an easy way to answer the question, we'll do. Anything that just, look, it happened. There's no way to fix this, but at least we already, okay, here's the bullet points. Here's the explanation. Here's the backup documentation. So that way, when you're sitting at the table with the buyer, right, and you've either pre-done this and given them the report, or you're at least ready, right, they're going to say, hey, I noticed in June of 2022, this thing happened. And you go, I'm glad you brought that up. Here's exactly what happened. Here's the backup. Here's the letters, the bank statements, or whatever it is. And then the buyer goes, oh, wow. Okay, great. Well, I appreciate your explaining that. And that makes a lot of sense. Because if the other thing happens, if they go, well, hey, what happened in June of 2022? And you go, I don't know. What are you talking? Let's see. Oh, and you go, oh, wow, I'm not sure why that's like that. You as the seller just lost about 20% off the sale price.
Isn't it? No.
Even if you could explain it later, right? Just the fact that you weren't ready and you didn't have to, and you have to go, oh, I got to ask the accounting team. I'm not sure. That just loses credibility, because even if you can explain it, the buyer's mentality is, well, I found that. They didn't even tell me about it. I found it.
Right.
What else haven't I found that I didn't ask about that's laying somewhere in there undiscovered? And that they immediately feel like, well, there's more risk in this deal because I don't know what I don't know. And now I'm nervous.
Yeah. And it's funny you say that, because one of the things that, and I guess one of the questions that I know everybody asks is, what's the difference between quality of earnings and an audit? And there's a pretty big distinction.
Right. And there's also, people talk about quality of earnings and quality of earnings light, right? So it really has to do with the size of the deal and the amount of money you're going to invest up front in doing this analysis, and also the level of liability you're going to transfer to the people who did the review, right? So most small business deals kind of come stamped by the broker with a disclaimer that says, look, the seller gave us this stuff. We think it could be good, but it's really up to you as the buyer to do your homework. When you go, you get a quality of earnings or an audit, then you're involving a third party who's not only doing the review, but also signing off on it and saying, to the best of our professional experience, this is accurate, and we will incur some liability to that fact, right? If it turns out you buy the business and later discover we were way off base and there was a lot of problems, that accounting firm is now going to have some liability to the seller or potentially the buyer to make this thing whole because they signed off on it.
So I'm certain everybody's going to ask the same question. What does something like that cost? And I know it markets vary and so on and so forth. But I always tell everybody, brace for a 5-figure. This is a 5-figure conversation you're going to have. And so that's part one of the question. But part two of the question is, does it preserve value or does it amplify value? If you hand somebody quality of earnings, do you get that money? It's kind of like fixing your bathroom or your kitchen or whatever in your house. You're going to recover that on the sale. Do you recover, when you do that kind of the preliminary work, do you recover it on the back end?
Right. So to address the cost first, when we do a review like this, it really depends on the size of the business and the complexity of the business. And we work with businesses that go from 6 figures to 8 figures. And the report, and the process can go from $2,000 or $3,000 for a small business that doesn't need a lot to $10,000, $15,000 for a large business that needs a fair amount of digging in and, recasting and so on. I would say the average cost for one of our clients with a 7-figure, sort of mid-range business, $7,500 to $10,000. Got it. Now, very important question that you asked, right? What do you get for your money? Essentially, is the question. What I see over and over again is 2 kinds of clients. One kind of client comes to us, or somebody like us, it doesn't have to be us, first, right? Before they go to market, you say, let's do this ahead of time. And if it's done right, like I said, you preempt a lot of questions, you fix a lot of things. And a lot of times what we can do is we'll dig through and find more value to add back that the broker didn't find and the seller didn't realize they could, right? Those one-time costs, who's Doris? Oh, Doris is my aunt. We put her on payroll, but she doesn't really, well, you're paying her $80,000 and you're telling me she's doing $15,000 worth of admin work. So there's a delta there that we can capture and put back. And then if you sell at a 4x multiple, Doris is now worth $240K to you by identifying that. I didn't even think of that. So we're on the hunt for value that we can bring back to the table for the seller. So that's one way you recapture it when you do it ahead of time. And the other thing that happens is when we do it ahead of time, the business gets listed at the right price. And typically the first buyer that comes who's qualified closes the deal. So there's time saved in from the start of listing to the close of the deal. You generally only go through it once because it doesn't fall out in due diligence. The other client that comes to us is we've had 2 buyers fall out. Why? Well, both times they found all these problems in the financials. So we really realized we need to fix that before we can go back to market again. All right, well, you burned 9 months in legal fees and everything else, falling out, finding, their due diligence team found all these problems, but now you've got to fix them before you can go out again. And now, when the third buyer comes along and goes, well, what happened with the first 2 buyers? Now you got to tell that story. Yeah. So I think you've added value by doing it up front if there's more value to capture, which there often is. And 2, you've saved that time of being burned on 2 or 3 deals that fell apart before you finally decided, hey, I guess, we can't just blow this off and say, it is what it is. We really need to fix and address these problems and be able to explain it to a buyer. And then we'll be able to actually get to the finish line with this.
Yeah. Well, I'll tell you one of the things you mentioned is finding things to add to the cash flow as opposed to take away. And I didn't look at it that way because I normally the folks that we're squabbling with, they have put so much on there, and it's like, man, you can't do that. No one's gonna buy into this, and unfortunately, then we're taking it away. But it's interesting that it can go the other way too. That the things that
Right.
that you hadn't thought of. Have you seen any interesting ways that this that this is done? Like, for example, I've often thought, as a deal shop, maybe we ought to, bulk up the retainer and pay for the Q of E ourselves, and have, that's just part of the deal cost, so to speak. Have you seen any interesting ways that that sellers have gotten that accomplished, or is it either some guy like me pays for it, or they pay for it?
It's we definitely have brokers we work with who pay us rather than having the client pay us. I think it depends on how the conversation goes, right? And how valuable the seller perceives their deal to be and how valuable the broker perceives the deal to be as to who they can get to pay for it, right? So sometimes, right, if it's a marginal deal and you sit down with somebody who's an intermediary and says, look, if you take it to market as is, you're going to get X. But if you can go work with CapForge and get this cleaned up and get this right, I can get you 2X. And I almost I'm not even willing to take it to market at the 1X because it's going to be such a headache and the buyers are going to shoot this thing to pieces with all their objections and questions. It's almost unmarketable without fixing it. But if you fix it, now you've got something legit, right? So those people, they will come to us and how much is it? And then they may, now if the broker goes, look, this is a fantastic business, even with these garbage financials, they go, I'll pay for it to get it fixed just so we can sell it and get you a premium. Because I know it's going to sell either way, but my job is going to be so much easier if I don't have to fight with the broker over all these, well, what's this and how did that, and what's going on. So it goes both ways, but either way, it facilitates the ability to sell. Sometimes to sell it all, and sometimes to sell at the price you could get versus the price you're going to have to take.
Interesting. So let's talk about the financials, and where are the common areas that you see that it's like, man, if you guys would only just spend the time to fix this. Where on the income statement and balance sheet are you seeing the most value leakage, for lack of a better term?
Oh gosh, I mean, it's kind of all over the place. One of the things we see all the time is commingling, right? Either between business and personal, or multiple businesses, right? With multiple business and personal, you can pull it out for the most part and make the case. Although some expenses, depends what it is, right? If it's, let's say it's a landscape architecture business, it goes, well, those supplies were from my house. Well, how do I know, right? Really,
we get that.
right? That happens.
A few times. Sure.
But the other thing is when somebody owns multiple businesses and they go, oh, Joe and Bob and Jane, they work for this business, but they mostly work for the other business. Mm-hmm. So again, okay, well, how do we know, how does that really split out? So if you can work that out ahead of time, do the allocation, come up with a backup, or take them off altogether, right? We don't really need them. I pay them from here, but they work over there. It's just always been easier. All that kind of stuff that happens, that sort of, hey, look, I own all the businesses, so who cares? Well, no one cares until it comes time to sell. And now people care. Now you have to pay attention to that.
So how long does it take to, like, if I unwind that, all right, so I've commingled payroll, and how long before the buyer can say, all right, you know what, I mean, I guess we readjust, all right, so we basically rebuild the income statement to reflect that. Does it? I can't imagine that it's helpful. Not helpful from the standpoint of, I think, confused buyers never buy. Period. End of story. There is, if they can't figure it out, you aren't selling. But where I was going with it is that, all right, so we rebuild it. Does the buyer look at it and say, all right, I can go with that? Or is there a value penalty that accompanies it? It's like you were mentioning earlier that, you got junk financials, and now if I find it, you got a value penalty. You disclose it, you probably not, or not as much. So I'm just curious to get your thoughts on, we're now rebuilding a set of financial statements. How, I don't want to say reliable, but how does the buyer perceive rebuilt financials that you do?
Usually what I'll say is the truth comes out, right? So if you say, well, look, I took this person off payroll because they're paid from this company, but really they mostly work with the other company. So we made a small allowance, and that's the truth. If they'll accept it generally at face value, but then if they go and talk to some of the other employees and they go, oh yeah, she was here all the time, she worked late, she came early, she worked on the weekends, they go, oh, wait a minute, hold on. We've had cases though, like with the last couple of years, right? Shipping has been crazy. We have some clients that do e-commerce, right? So shipping has been a big thing. We've done recast financials using today's shipping cost. Look, if I was paying today's rate for the last 24 months, instead of these crazy up and down all over the place COVID rates, this is what I would have made. Now, these aren't our final financials. This is an Excel recast to show you what it would have been. But look, here's the invoice today for shipping. Here's the last three. Here's the price I'm paying. And if I had been paying this price all along, this would have been the margin. Now, yes, I didn't make as much as that because of this, but that's the only reason. And here's today's prices. Again, most of the time the buyer will go, yeah, I mean, that makes sense, right? The shipping craziness is not, you're not making it up. I can go find it in the news. I can see the invoices from today. I can see the math. It makes sense. So buyers are open to that as long as the story, keep it simple and keep it true. That's my advice.
That's a great. Keep it simple and keep it true. What from a lending standpoint, though, I know that commingled financial statements or commingled financial statements that tie into the tax return, I don't want to say it's the kiss of death, but boy, it makes life a hell of a lot harder than it needs to be. So I guess you got any tips and tricks to survive the scrutiny of the lender underwriter?
Yeah, I mean, a lot of that comes down to who the lender is and who the underwriter is as to how much slack they will cut you. But I will agree. I mean, their standards are significantly tighter for that kind of understanding than a buyer. So if you're in a market space, market size where the buyers are going to be predominantly dependent on SBA loans or financing like that, that's the standard you have to meet. So if your stuff is, again, a total disaster of commingled garbage, you're going to A, have to clean it up, and then B, run things for 12 months through at least one tax return cycle before you're going to be legitimately able to sell to somebody that needs to go get a loan. If or you take a very low price from somebody who can come up with some deposit and you're going to carry a seller's note. That, you kind of have to, again, this is why don't decide tonight you want to sell your business and list it tomorrow, right? Unless you want
right.
the lowest possible price. If you're thinking, an exit is in my future, then start asking the questions now. Who would the buyers be? What kind of financing? What kind of requirements are they going to have? And then, you got a nice runway, 12 months, 18 months to get that really set up. And now when it comes time to list, all your ducks are in a row. In fact, you could even go and pre-qualify the business for an SBA loan, which is a great gem to have in your listing, right? SBA pre-qualified. That tells them we already know the hoops they're going to ask us to jump through, and we can jump through those hoops.
That's a good point. What sale prep services that you guys do? I mean, I know you've touched upon Q of E and cleaning up books. When you're consulting with these people that are starting down this path, what are those conversations like?
It's really, look, the predominant way that you get the best price for the business is by having the most profitable business that you can. So, and that's good to do whether you sell it tomorrow or you sell it 2 years from now, right? Why wouldn't you want to optimize the business? So let's look at all the places that over time as a business owner, you kind of take your eye off the ball and stuff accumulates. Excess inventory accumulates. Excess assets, right? Not too long ago, we did a project for a guy at a street sweeping kind of company, the kind of things that go around the city at night, parking lots or whatever, right? He had 9 street sweepers, only 4 of them ever went out of the yard. Like, well, what are you doing? Excess employees, excess, sometimes people sign up for all kinds of software subscriptions. I haven't used that in years. Well, quit paying for it. Or, just all that kind of optimization stuff. Again, some of our e-commerce sellers, they'll have 50 different SKUs that they're selling and 10 of them they lose money on. Well, dump that in and stop selling that stuff.
Yeah.
Oh, well, net, we make money. Well, net, you'd make more money if you stop selling money-losing products. So it's really, the process you go through to sell the business is also the process you should just go through in general as a business owner to run an optimal business. Now, we all get lazy and tired or, work-life balance, whatever. You don't always have to keep everything screwed down to the tightest, right? But if you're planning to sell, those are the kind of house cleaning things that you want to do. It's not dissimilar to when you go to sell your house, right? You go through, you paint the chipped walls and you fix the squeaky door and you do all that, the window screen that was missing, you put all that stuff. You can live with it because who cares? It's your house, right? But then when a buyer is going to come and look at it, wow, there's paint chips, squeaky door and missing screen. You fix all that stuff and now you get a better price because it doesn't look like a fixer-upper anymore. So same thing with the business.
You're right. It's funny you say on the subscriptions. One, and this was a tip that somebody else had given was, at the end of every year, this guy changes he cancels his credit card and just gets a new card with a new number. And it forces his team to see, all their recurring charges and and good on him.
Yeah. I mean, that's a good way to do how, because well, this canceled. I didn't even know we had it. Well, then obviously not going to renew it, right? Who cares?
Right. So, I mean, it's kind of low hanging fruit, but it gets the job done. One of the things I wanted to talk to you about had to do with winding a company down. 2 things. One, what's it look like transitioning accounting to the new buyer? How does that occur and how painful is it, for everybody, I guess. And that I want to, let's start there.
So it could go either way, right? Most of the businesses that we deal with do asset sales. So in an asset sale, the buyer has their own entity and the seller's entity stays on, but they're transferring their customers and their IP and their assets and everything else. So the new owner is basically starting books from scratch. But They can use essentially the same chart of accounts and set up invoicing the same way and copy over vendors and customers and everything. And we do that kind of project all the time. It's really not that painful. And in some ways, it gives you a chance as the new owner to optimize, right? This guy had all this stuff in here that we don't even need anymore. So again, it's like, let's start fresh and just really set it up for success this time. Don't carry over any legacy baggage that we don't particularly need.
Right.
If it's a stock sale, then the entity doesn't change at all. It continues on. It's just the ownership of that entity changes. In that case, nothing really changes with the books. They go on exactly as they were. It's the same everything, just, new ownership. So that's even easier. But in either case, that's a project we do all the time, and it doesn't have to be a disaster as long as you take care of it, right? Now, some people get the new entity set up, but they don't get around to getting a bank account. So they're still using the other guy's, bank or merchant account, and you credit me this, and then you can make it a disaster,
Yeah.
but it doesn't have to be.
Okay. So one of the last questions I had to do with projections, and you help your clients make projections, right?
Yes.
I mean, how, from a advisory standpoint, I mean, you can tell me what the project. I mean, as a valuation guy, I know business value is earnings, growth, and risk. That's all it is.
Mm-hmm.
From a deal guy, I'm looking at what are companies like yours selling for. So when you start putting projections together, I've never I try to conservative projections, the pro formas and such. On the sell side, I'm curious to know how you build your projections. And, because I think we serve, roughly the same avatar. And I'm just curious to know how you're able to do that. Cause I'm certain you are. I just don't know how, do they come to fruition? Do you ever like circle back and just, cause I know I do. whenever I've done projections, I'm like, I wonder, 3 years down the road, how close was I? And normally you don't want to know that answer.
Well, if the projections are because they're required, like for the SBA, right? You got to have business plan, you got to do projections.
Sure.
We just get this standard 10%, 15% a year, whatever. It seems conservative. The new guy's going to come with some new energy and try to grow things. But, those are worth exactly the digital bytes that they're printed with, right? They're completely crap.
Yeah.
So, and this is one of the things when I counsel people who are looking at buying a business, I always tell them, look, if you don't come to this deal with a solid plan to grow it, don't do it, right? Do not expect to buy a cash flow machine that you can just sort of stand back and expect to maintain status quo, right? Everything, it's either growing or dying. And if you're not sure it's growing, then guess what? It's dying. Yeah. So, if you're getting into something that you're brand new to, you better start doing your homework immediately. Yeah. Or even if you think you've got some experience, right, make sure. I hear from people all the time, well, you know what, the current seller told me they don't do any advertising. So I'm going to start doing advertising and that's going to grow the business. Well, how do you know, right? Did the other guy try advertising and it didn't work? That's why they don't do it? Or is the cost of ads 3x the lifetime value of the customer? Well, then that's not going to work either. So figure out what your growth plan is. The best buyers are somebody who's already well aligned with the industry, right? It's a strategic acquisition, or somebody who is maybe a C-level executive. They're buying into their own, but they know all the customers. They've been to all the trade shows. They know exactly what the pain points are. And they go, this is my plan for my 5-year plan for growth. It's all laid out. I've already had the conversations. As soon as I buy this, we've got invoices. We're ready to send it. That guy, they might be 50% year over year growth. That could be, so you probably wouldn't put that in your projections, but that's what they could achieve. And on the other hand, somebody else who feels like, oh, I'm just going to buy it. I'm going to manage it from a distance. I'm just going to bank the money. Yeah. Okay, well, I'm going to project it.
Well, it's funny you say that. I mean, there's so many courses and so much so much noise out there on how easy it is to buy a business these days. And I don't think there's enough people that are sitting there pumping the brakes saying, you know what, there's a lot more to running a business than just being able to create a real sexy spreadsheet. And I don't, now granted, I have, if you look at the default rates on the SBA, they're not very high. I mean, they're making good deals. So somehow, some way that, these projections and these people that are buying it, it's good. Now, maybe we'll see it different, 2 to 5 years from now. But I guess where I was heading with it is that it's just, you can't run a business from a spreadsheet. I think you see that all the time. All right. My last question I ask of every guest I've ever had is, if you had one piece of advice that you could give to a business owner that would have the biggest impact on its value and or sellability, what would it be?
It would be start early. Start the process early, right? If you're thinking about selling, the longer the runway you can give yourself, the better off you will be. And honestly, the way I run my business and the way I'd advise anyone else to think about running their business is always run it like you might sell it, right? Because if you're doing that, you're not allowing excess inventory to build up. You're not overstaffing. You're not paying for subscriptions. You're always keeping an eye on what is the enterprise value of the thing that I'm running. If I sold it tomorrow, how much could I get for it? And is that the best I can do? If you're always ready, your financials are clean, your metrics are good, your growth is there, your profit is optimized. And I don't mean down to the last penny, but generally speaking, you're running it as if at any point you could sell it. Then you're probably running it really well for the most part. And you really are ready. If somebody come along and say, look, what you've got strategically fits into what I'm building, and I just got a stupid amount of money from some investor and I'm willing to pay you a stupid price, you could do that deal on short notice, which is, probably not going to happen, but it's just being ready, I think, overall helps you be a better business owner. So that would be my advice. Run it like you're going to sell it, no matter when you actually sell it.
That's good. All right. Well, how do we get in touch with you?
So the best place to find us is the website, CapForge.com. It's got lots of information about me and us and our services, and of course, an email contact form and a phone number. I'm always happy to have a conversation with anybody, whether you're thinking about selling or not, you're not sure if you want to change accounting firms or not, or just general business advice. I'm happy to chat with anybody. If we can be of service, great. I'm a big believer, and it comes back to you eventually, right? Whether it's the guy I talk to or the guy he refers me to later or something else, who knows? I'll put it out there. It'll come back.
Got it. And you can do work across the country, yes?
Oh yeah, we've got clients in all 50 states, and actually a fair amount of clients who are foreign who own U.S. entities as well. So we're pretty broad reaching. Nice.
Well, Matt, I'm really happy that we had the opportunity to talk. It was a good one. And like I said, you're the first guy that does your kind of work that's been on the podcast in 120 episodes. So you delivered, my man.
All right. Excellent. Well, hopefully if we can be of service to anybody who's listening, we're happy to do it. And I think honestly, there should be more of us out there. I think this is a key piece that a lot of times doesn't get looked at until too far down in the process, to where it could have been a lot more help if it had been done sooner.
No, great point. Well, thanks, my friend, and have a great holiday.
All right, you too. Thanks for having me.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.